Welcome to the podcast. I'm Eric Salzman, joined by Richie Bennett and Kevin Doherty. How are you, fellas?
What's up?
Good, good. Special Saturday podcast.
Yes,
Yeah,
yes. What's up? Not situational awareness.
no, they have no situational awareness at situational awareness.
So, Kevin, tell us about situational awareness, the story that broke this week.
This is the hedge fund by AI wonderkind Leopold Aschenbrenner, who look the guy's super impressive. And 2 years ago he wrote a memo basically saying the age of AI superabundance is upon us and nobody realizes it. And this is going to be the big investment theme of the next few years. And there's incredible opportunity here. And at the time, I mean, he was 22 years old,
Right.
graduated from Columbia University at 19 years old with highest honors, worked at OpenAI on their safety team
Mhm.
and left apparently because he was warning that they were not taking safety seriously enough. But
They fired him. He was
they
fired.
fired him. Yeah. Um, and before that, which is an interesting, we'll come back to his bio before that, but super smart guy, super impressive. From the point he wrote his memo to now, he's been right, frankly, about the direction of things. But he got ahead of his skis using leverage.
Mhm.
And the picks in his fund did amazingly well. But it turned out he was using 4 times leverage in his fund, which means, you know, the value, the equity capital in his fund, the amount of investment he had, let's say it was $10 billion, but he had $40 billion worth of positions that
Right.
he bought in his fund. And
Now, just
so,
to lay this out is that the kid has no investment experience. He's never run a fund.
right.
Right.
But because he was, and they called him the Nostradamus of AI, that a lot of big people stepped up and just put billions of dollars of capital into his fund and
Called situational awareness.
situational awareness. Because I think that was the name of his paper. I think that
Yes.
was the name of
Yeah.
the paper. And he did what you'd expect somebody who knows a lot about AI and is really smart and never probably bought or traded a bond or a stock in his life. He just went out and started buying. And then someone said, hey, you can use this thing called leverage. Like for every dollar you put in, you could, or your clients put in, you could borrow another three or four. And here's the people who do that thing. And that is the big Wall Street banks, like in this case, it was Bank of America, Goldman, there were two other big, they're called prime brokers. So if you're a hedge fund, you basically house your assets at a prime broker, and the prime broker does all sorts of cool things to you. One thing they'll do is they'll lend you money. So they'll lend you money to leverage yourself up. They like doing that. But with this guy, he was buying, it was all AI centric. He was buying one big sector and just waving stuff in left, right, and center. And of course, it was going sky high. But he was using leverage, so your gains are amplified, but your losses are really amplified. And what happened is when I don't know if it was SK Hynix or what ticked this off, but all of a sudden, all these stocks started going down really hard, like 20,
Not just
30%.
that, but his longs went down and his shorts went up because, he convinced himself, hey, I'm hedged a little bit. But,
Yeah.
that's a Texas hedge, right? You're,
Yeah, what he did was he put on the anti-rotation trade. He basically said,
yeah,
"Yeah, I'm going to sell these boring stocks." But the thing was, there was no risk management. But the
yeah.
other thing is, so anyway, he blew up, and we'll get into more of what happened and what happened at the poor guy's wedding, unfortunately. Um, but you have to look at the if you remember the story, and maybe I don't know if our viewers know, but there was a guy named Bill Wang, and Bill Wang ran a family office that was called Archegos, and Archegos, I believe, got themselves up to about $20 billion. And what that guy was doing is he was doing business with all the big Wall Street banks, they're prime brokers, and they were. We won't get into the whole credit default swaps because he was doing something. I'm actually surprised credit default swaps didn't make its way into this particular disaster. But anyway, all of these guys lent this guy tremendous amounts of money, or they did these derivatives with him that put them on the hook if that guy disappears one day. And sure enough, none of the prime brokers knew. Each one did not know that the other were doing the same trade with this guy, and he was lying to them. He wasn't giving them the full picture. So when everything kind of blew up, I think he was Paramount, Discover. It was to certain stocks. He was moving the stocks himself, buying them by such massive volumes that he blew up. Credit Suisse, that was the last nail in Credit Suisse's coffin. I know Nomura got clobbered. I think UBS got clobbered. Deutsche Bank, like Morgan Stanley got hammered. So all these prime brokers just afforded all this risk because they needed to be in the game. This was a big player getting with this guy, and they lost billions of dollars. And then you fast forward like 3 years later, 4 years later, and these guys kind of did the same
Do
thing.
it again.
Yeah.
Yeah.
So, for those of you at home, think about this. Think about if you buy a house, right, and you get a mortgage, and you go and look for another house, and you try to get a mortgage. Don't you think the banks know via your credit report what kind of stuff you have on the debt side versus the asset side? I think so, right? You hear a lot of people getting turned down for mortgages because they are, a banker looks at their credit report, takes about 20 minutes, and the team determines, yeah, we can't have you having 4 houses. Now, that used to happen in 07 and 08, and we all know or most of us know what happened there. The whole world almost blew up, financial world. So it's always crazy to me when stories like Eric just told, like there seems to be no credit check for the biggest guys who have like $20 billion. So
Right.
like the fact that Morgan Stanley and all these names, right, that you mentioned that everybody knows, couldn't do a check or just believe this guy, like yeah, okay, dude, yeah, we can lend you that. We can lend, yeah, billion, yeah, with a B, right? Yeah, you got it.
Well, but let's give credit where credit's due. Barclays turned him down.
Yes, there's always one good guy. There's always one good guy who's like, nah, wait a minute. And usually those are found out by, like, in the old school, I don't know what kids do today, but in the old school, that's found out at the bar
Right.
at night. Like, wait, you guys are going to lend that guy money? We just like, what? Yeah, and so did this guy, and so did all around, like a napkin and a drink. Like,
Right.
hey, credit guy, I was out last night, and so and so at XYZ firm said they're doing the same thing. I don't know what he's telling you, but he said they did it. Okay, let's put and that's how it happens. Not like some fancy computer model. It's like word of mouth. Like, they're doing this shit.
And there's always a senior manager somewhere in the bank that if you don't do it, he'll hear things in his social circles and be like, "Why aren't we involved in this?"
Right.
And either I'm going to fire you and put somebody in who has some balls. Like that's kind of how this happens, right? It's not these guys know that if this is all working out and everyone's making a ton of money and I'm not, I'm going to be judged on that at the end of the year, unless it blows up. Like, and honestly, you don't get a big bonus by missing a disaster.
No, you get to come to work the next day.
Yes, come to work.
That's your bonus. You didn't get fired because you missed. But thank you.
So again, like I have nothing. I've heard almost nothing but great things about this kid. He's a smart kid. He's a thoughtful kid. It's the people who gave him the matches and the gasoline to just do what he did. Right?
Any word on whether or not he must have hired some experienced.
I heard
hedge fund guy
at the Citadel, but yes, apparently, but I don't know if those guys came on. I don't know when those guys came. They didn't start out with those guys, but like, wasn't there some sort of a risk management or some sort of document or something that said what they were doing and how they were doing it?
Probably not. I mean, he probably just sat there. I mean, I don't know the guy and I've never heard him talk, but you wonder, like, do they trot this guy out in meetings? Probably to the big guys, but
Sure.
he might sit in the corner and be like, "Yes, I have good ideas," and that's it, right? Whereas like the marketing guy, hopefully, I think it sounds like he did have somebody
Right.
raising money for him, so they can be like, "Yeah, you're witnessing like they're basically probably like this is the Michael Jordan of AI, right?
Right.
You're lucky to be at this table. Give the boys some money and watch your dollars grow."
And they did.
And they did.
Well, there's another interesting part of this story, which Richie mentioned that he's getting married. Actually, I think he's getting married today, about 50 miles down the road from where I'm sitting right now.
They had to cut the open bar.
Yeah, well,
And make sure you're bringing gifts to the, he might have asked for no gifts before, but I think changed.
Yeah.
well, that's the part. So Warren Buffett famously said that Wall Streeters typically go bust through one of the three L's: liquor, leverage, or ladies.
Yeah.
Now, it's not going to be ladies because he's 22 and he's getting married, so he hasn't had a chance to cheat yet, and it doesn't seem to be liquor, but it was leverage. It was the third L. It zapped him.
See, and this goes back to a mentor of mine back in the day when I was like 22. Same thing, same conversation. Richie, you can like women, you can like gambling, and you can like drinking. Just pick one. Just pick one. If you do all three, you're toast. So it sounds like he only did this one, but he still is now toast, right? It sounds like he only did the gambling.
Well, and the wife angle is really interesting for two reasons. Number one, she is the chief of staff to the CEO of Anthropic.
Right
So
on.
his whole investment thesis is he is investing in the AI infrastructure. So yeah, he's got a big investment in Anthropic. So, and that's fine. That's a private equity investment. Nothing wrong with that. His wife works there, no problem. But he's also investing in all these companies that Anthropic is, the top of the pyramid, and they're buying chips and they need next gen energy. They need all this stuff. So, his investment thesis is to invest in all the things that Anthropic is going to be generating income for, and his wife sees everything. So this is like an arbitrage hedge fund guy who's marrying, the head of M&A at Skadden Arps. Like there's something they better be really careful here, or if there's an aggressive SEC. I'm not implying anything, but that's a little fishy. The other interesting tidbit is you guys know where the two of these lovebirds met? They worked
OpenAI?
together. No, it gets even better. They worked together at FTX,
Ah,
our old friend Sam Bankman-Fried's shop. To be
That
fair,
that place is just spurring out
the
talent.
apple doesn't fall far from the tree. But to be fair, it appears they worked in the investment arm of the kind of the philanthropic part of FTX, because these guys were all tied into this effective altruism idea. And so it doesn't appear, well, clearly, I think we can say Aschenbrenner was not exposed to the risk management failures of FTX, because he clearly learned no lessons about risk management from that experience. But yeah, it's amazing story.
yeah. So for all of you that were seeing this just huge volatility and all these stocks of like, SK Hynix came out their US ADR, basically on onshore. And within a few days, that thing was dropping 5-10% a day. I think it was down almost 50% at one point, right? And it really, I mean, it certainly crashed through its initial price offering as IPO. I don't know if you call it an ADR an IPO because it already existed in Korea. But long story short is the market was, if you remember, it was extremely volatile, swinging back and forth, and part of you is like, boy, there's got to be some leveraged players, whether it's really risked up players that are getting margin calls, and this is why this is happening. And I know we've been talking about it certainly over in Korea with the 3-time levered ETFs on single stocks on these companies. So it made sense, but then it really made sense when you found out that this guy was blowing up. And the way that these guys blow up is that their brokers call up and they say, "Hey, we need our money. You got to put up more collateral. Or we're going to sell your shit because the stuff's going down and we need more capital." So at that point, the guy was scrambling around trying to find a way to basically, without having to sell all of his publicly, because he has private deals. I think he owns a big chunk of Anthropic, right?
Yeah.
So he owns
Mhm.
private deals, but then a lot of his stuff is the public, the stuff that you see trading every day. So he didn't want to sell that. So he was trying to figure out a way to maybe sell some of the private assets and do kind of an under the table thing to raise capital. Nobody wanted. So at that point, the guy who always shows up is Ken Griffin from Citadel.
Big Ken.
Big
Big
Ken.
Ken. I wonder how he must have like great talks with the street, right?
Oh
Like
yeah. Who's
he
that
must
guy?
like somebody like senior probably said, "Listen, we don't need this whole thing to unravel because this kid is leveraged to the hilt and he's going to have to sell everything soon. Can you come in and help?" And
No.
right, Ken's
Oh,
like,
I'll help.
"Oh, I got money. I'll help."
And it was a battle between how did Boaz Weinstein not get? I guess he didn't have enough capital to do this.
No,
But,
he didn't have enough. But what you call
Izzy
it?
Englander, Izzy from
Is
Millennium
he?
was
Yeah,
also.
yeah.
Look, imagine that you're
He got
this
outbid.
24-year-old kid. You're being bet you're over a barrel, and you're looking at Ken Griffin on one monitor, and you're looking at Izzy Englander on the other monitor. I think Richie and Kevin. I think actually the way this happens is a guy like Ken Griffin has been around a long time. Englander, all these guys, they see this. They're like, that guy, yeah, he's buying extremely volatile stocks, and then he's leveraging them up 4 times. Like, let's watch that because there's a good chance. Like, let's be ready. Like, start watching all of their positions and stuff, and doing this and running through our models because when that guy blows up, we want to be first to the door. We want to know exactly our pencils already to be sharp as to what we're going to pay. And I know that I think they bought all of the public shares of what he owns at a nice discount.
Yeah,
10%, supposedly.
10%.
10% to market price.
yeah. And
And then they all spiked the next day by
of course
25
they
or
did.
30%.
Yeah. And going back to our discussion around how do these guys not figure out these big hedge funds that they're doing this and that and the other thing, and you're trying to buy 2 houses, one for an investment and one to live in. This is as if, so all right, it's public record. You bought a house as a person, right? But this is almost like you're thinking about buying another house and you haven't done it yet, but everybody knows your business. Everybody. And you're like, how does this happen? I didn't apply for the loan yet. I'm just looking. But this is what goes on because if Big Ken calls you on the phone, you pick that phone up, right? He has not been hung up on, probably maybe by his wife, but he has not been hung up on, or at least not called back within 30 seconds of anybody in the last 20 years, right? So he may just call and be like, "Guy, who's having trouble with you guys today? There must be some trouble. What's going on here? Because I see like large amounts of stock trading, and there's a big seller out there. Who could it be? Who could it be?" Yeah. And somebody tells him. That's how it happens. Like somebody says, "Oh, you didn't hear this from me, but it's that kid that is the Nostradamus of AI." Right. Oh, somebody, and then Ken hangs up probably doesn't even hang up the phone, puts the phone on hold and says, "Jerry,
get in here.
You come right in here now." "Yes, boss." And like, "Cool. You know anybody out there?" "No." "Okay, find somebody.
Get a couple of them athletes in here.
Tell them you got money. You got money to spend. You're ready to go."
The other part of this is at the final crescendo of the
Oh,
Kevin.
Well, while
We'll
we're
get it.
waiting,
Tanked.
there
Sorry,
it is.
did I freeze there?
You
Yeah, yeah,
froze.
you
You
froze.
look good though.
Sorry. All right. Well, I was saying that the final crescendo of selling that happened earlier this week, um, the people point to the Citadel's macro guru coming out on Monday and saying, "Hey, I think the Fed's going to raise on Wednesday."
Yes.
And so that caused the final puke of these stocks
Hmm.
that pushed the banks to tell Leo, you got to
Yeah.
sell. And so, if you want to really believe in the Dr. Evil Citadel scenario, there it is.
Yeah.
That they knew.
We could go right into the next the next subject from that
He's
was
there to scoop up his championship belt.
gotcha. Yeah. So we had a Fed meeting, a very historic Fed meeting this week that culminated that ended on Wednesday, the Federal Open Market Committee, FOMC. And interestingly, going in, so this is going to be a big meeting. This is Kevin Warsh's second meeting, and obviously inflation's still, the inflation is still way above the Fed's 2% goal. It's been going on for 5 years, and he's been talking tough about it. So I noticed watching Bloomberg TV leading in because I wanted to watch when the statement came out. I mean, there was the guy I forget the guy from the chief investment officer at J.P. Morgan was on. A bunch of different like the big talking heads, big power guys and gals, and they're all wringing their hands that it's too early to raise rates. Like you should still wait and see, and maybe we should be looking through this energy thing and blah blah blah. I'm like, all right, yeah, I think you should raise rates, but whatever. And then he comes out and they don't raise rates. And then the market completely shits the bed. Like all of a sudden, everybody is hammering Kevin Warsh for not raising rates. He should have raised rates. And then everyone was really hammering him because he came out again and it was very pleasant, but he's tight-lipped. He's basically saying the market is going to determine where rates should be. And basically what his announcement was, I'm not going to hold your hand anymore. The Fed is done holding your hand. You've gone through since 2008 of being told that you've been given the answers to the test 6 months ahead of time. And you know what? It's real easy to make money. You remember the when the Houston Astros were cheating, when they basically the players would come up and they know what pitch was coming. And I remember they asked the great Mike Trout, he goes, "What would happen?" He goes, "What do you think about this, Mike?" He goes, "Well, all I know is if I knew what pitch was coming ahead of time, I'd be having a lot of fun up there." And that is what this market has been doing. And I mean this market, I'm talking about private equity, private credit, hedge funds, like everybody has been, and even this whole thing about the leverage. We talk about leverage and how it amplifies his losses. Well, it's a lot easier to take leverage and to do things and take risk and blow up bubbles if you pretty much know that you know what the Fed's going to do, because all of a sudden, because borrowing has become so important to finance these days, right? In the last 20 years, that's become the most important thing to these guys is what is the Fed going to do to borrowing costs? And I mean, I'm talking about short-term borrowing costs because that's my life's blood. And Kevin's talked about it plenty with crypto, and liquidity is what drives these risk markets. Well, if you start making liquidity, not that you're taking it away necessarily, but I'm not telling you that this is what I'm going to do for the next year, barring bad things happening, then it's a lot easier to take those types of risks, create the kinds of bubbles, and have what happened this week with this kid at Situational Awareness.
And we talked earlier in the week amongst ourselves. Again, I keep going back to this theory, not even a theory, a fact. Like this stuff's going on again at near all-time highs in the market. Like in stocks, right? Like near all-time highs, everything, right? So this is going on, these are like risky bets that are still, some of them are still doing fine. People are trying to, tap the brakes a little, but it's still fine. I mean, I don't even know what happens and we haven't had one in a long time, but like a 20% drop, like, just a big old, well, it was coming, right? We've been going up so far, so long, and 20%. And some people would say, you know what, that's healthy. Let me go in now. I'm going to go in. Let's not make it 50%, but if it's 20%, I mean, these risky guys are done. Like they'll be taking them out. Like it's just, you can't have like I was trying to wrap my arms around this guy, the kid at Situational Awareness. I think the fund was up 80% year to date.
It's still up after all this.
I think after it all, it's 80%.
Up 80. It's down 67% in June, but up 80% even after that.
And he's been taken out.
Yeah.
And he's been taken out. Right? He's out. Like AI, that's all anybody talks about. This is Nostradamus of AI. He's buying AI, leverage, and then kaboom. And oh, wait, the AI stocks went down 50%? No, not really. They're lower than their highs, but no, it's not a catastrophe, but it was for this guy. And I think
my theory on that, Richie, is just that, and your point was that I think that all the guys that lent them the money, i.e. the prime brokers, they saw oh my God, it's Archegos 2 coming up. Yep. And this is a great job. Like if you could rise to the top of being the head of prime brokerage, it's an easy job and it's definitely a 7-figure job. I don't want to lose this job because I have no idea what my next job. It's gonna be a lot harder being a house painter than this. And that's why these guys, they definitely rung him up. Like, probably they didn't give him any leeway. In other words, he crossed a certain line and that was it. Boom, gone.
And if you don't think these prime brokerage heads at all these different places aren't like the 5 families in with the Corleones being at the top, you're nuts. Like they all talk. Now, obviously, they want to do better or whatever. It might be a competition and stuff, but they might have their little codes. They might have their little, hot phones. Mm-hmm. It's like, yeah, dude, we're closing him down. You might be wise to do the same, right?
You never want to be last. You never want to be last. And they found that out in Archegos too, right? Where Goldman was like, remember they're all in the room, they're on a phone call, and Goldman pretty much like, oh, we'll be right back. And all of a sudden they start selling.
Click.
No.
Go ahead, Kevin.
Yeah, I was just going to say, it could be, that you could see both bullish and bearish short-term futures coming out of this. The bullish argument is that the biggest leveraged guy and the biggest leveraged country, Korea, have had their big washout. And the Fed has come out and said, don't count on us to, you need to be more careful about your risk management because interest rates, we're not telling you what they're going to be. So it could be that a huge amount of risk has just been taken out of the market this week. Right. And so that, that's a flush that can let things gradually rise. Or it could be that was just the first cockroach. Mm-hmm. And that was like the Bear Stearns mortgage funds in whatever it was, May, June 2007, that was just like, oh boy, there's a lot more bad to come. And but as I've said previously, I have no conviction on which direction we're going of those two.
But what's interesting, unless and he could be doing, he may truly, Big Ken Griffin might truly run a hedge fund, hedge being the clear word. He may have done something on the other side of this trade, but he clearly bought these things not thinking they were going to go down immediately, right?
Right.
So he's somewhat, he could be neutral and just was able to extract a bunch of money immediately, forever and ever, but he wasn't thinking this was a bad idea to go long something that this guy had. He just looked at this guy and said, this is a fire sale. We don't get a lot of those. Same thing with Izzy Englander, who runs Millennium. He saw it, right? These guys are not dumb. They have huge portfolios. So, that's what I was saying before, like we came on, things aren't so awful. Like these stories are awful. You don't want people blowing up. The crypto's still not great, but that RSP ETF I talk about, the ticker is RSP, Richard Sam Paul. is 1.5% below its all-time high. That's
And
it.
what is that one again? That's
It's the equal weighted S&P 500. So everything is equal. So when you hear people talk about the Mag 7, the Mag 7 controls is like close to 40% of the S&P 500, right? NVIDIA takes a nap, the whole thing falls down that day, right? This ETF counts NVIDIA as much as the 500th ranked company in the S&P. So it's just a market directional thing. And that's saying, hey, we're still good. So what that tells me is, the breadth of the market is good, meaning people might be selling a lot of the Mag 7 stuff, but they're not putting it under their mattress, right? Like they're just shifting into the stuff that's boring, right? The boring stocks that make money.
which happened at the end of the dot-com bust,
Correct.
where suddenly value did well because
Right.
growth got destroyed.
And I think a lot of people are looking at that, like energy, financials, buildings, like materials.
One thing, guys, that just back to Kevin Warsh for a minute. So what we've seen since Wednesday is just hand rigging in every major periodical, whether it's the Financial Times, everybody's the Fed's losing credibility. The Fed, like I've never seen anything like this. And it's like, well, because it's a bunch of spoiled children who you're taking. Daddy has finally said, you know what? We're taking the training wheels off. You've had them on you should be riding a big boy bike now. You've been riding a little boy bike for too long, and it's time to take the training wheels off now. And you know what? I mean, do you remember all the times, the bond vigilantes, and the bond vigilantes would suck if you were on a trading desk and you were long, but the bond vigilantes were people who said, no, you know what? That budget deficit's too high. Or, oh, you want to cut taxes or you want to raise spending? Guess what? No, we're not. Yeah, we're selling. And that is what kept, to some degree, the United States government in line. And the last, since 2008, there's no repercussions about adding. Trump wants $1 trillion. He wants to take the defense budget from 900 billion, whatever it is, to 1.5 trillion. Done. Great. Yeah, and it's like, how about no? How about you can do that, but when that election comes next week, we're not buying. In fact, we're selling, right? And that is so obviously, so long-term rates went up a whopping, right? Everyone's going, now granted, if you're long, especially, it was a bad month for most fixed income desks. I know that. But yeah, if you were unaware that after this meeting, the long bond was going to shoot up, 10, 15 basis points, and the 10-year was going to go up 8 or 9 basis points where it closed, on Friday. This is probably near the average of where rates have been over a long period of time. Basically, what I think Warsh is saying, it's over, it's done. We're not doing that anymore. And if you want to spend recklessly, well, you got to deal with those guys, right? The Fed is not going to in the business of bailing you out by buying duration or doing whatever they have to do to keep a soft cap on rates, quite honestly, on the long end of the curve, and on volatility. That's the way the market was, and it functioned perfectly fine before everything blew up in 2008, and we're going to go back to that.
Yeah, and I don't know if you saw on Friday, after all this hullabaloo, what's he come out and say? Yeah, that's nice. You guys hate me? Great. You know what I'm thinking is a greater idea? We're gonna have less meetings. How about that? You don't think we're showing enough of our hand now? Guess what? We're gonna have less meetings, and then we'll show even less. Go kill yourselves. Basically, is what he said.
Yeah.
Go ahead. Now, I think all these guys, when they perceive a bubble of some sort, and there's probably some talk of bubble in certain stocks, right?
Right.
Like some of these P's are out of their minds, right? The goal, the wonderful miracle could be just to yes, there'll be some compression in asset prices, but it's a nice like grabbing that potato chip bag and kind of squeezing the air out of it slowly, right? Everybody wants that as a Fed chairman, Fed member, whatever. Rarely does it happen, right? Like they will, he may push something, and maybe he wants to. I don't know.
I think he does.
he might push something real bad soon and be like, yeah, what's it? I've not seen this at all. What if he, right? So now everybody's like, I think it's 60% on the betting markets, the prediction markets.
Oh, for next
60%
week.
he'll raise 25 in September. What if
Yeah.
he raises 50? Like 50, and you know what? Let's see what happens. Let's see what
Yeah.
happens. Right? Like I might be done for a while, but kablooey, right? Like things will go to the shitter, like
Right.
fast. But he could do that, right? He could, and Trump will be like, "What are you doing, dude?" Nah, don't worry about it. You're good. We're good.
Well, it's funny because like if it's this was and actually I think Diane Swank, she's been around. She's a really I like her. She's a good economist. I can't remember where she is now. I know she was I think she was a candidate she was at Mesereau for a long time, but then she's been and she was the only one pre-meeting when everybody was saying, "Oh, there's no way he should cut rates now. Raise rates now. It's it's too early." Well, and she goes, "Look, this has been going on every month, month over month, year over year." And what no one ever talks about is inflation those are compounding numbers. It's 0.2% up for this month off of the 0.2% last, and it is and obviously you go to any American and say, "Hey, is inflation moderating or is it slowed down?" Like, fuck no, everything everything I pay for. But my health insurance went up 25% this year. I go to the grocery store and I go in this thing I'm spending 50, I spend 80. Every single thing that you need for your daily living has gone up a lot. And if it stopped going up 10%, now it's only going up 1%, that isn't helping, right? So I don't know what the answer is, but I think this guy is going to be eventually the answer to just, like Clemenza said in The Godfather, right? You need one of these wars every 20 years or so to gets rid of the bad blood. We haven't had that in a long time, and we need that. Now I think I've had a rant. That's like 3 rants already on this podcast. I'm sorry.
That's a bit.
Well, we haven't even talked yet, and we probably don't have time to really discuss it today. Maybe next week it'll be the thing that's front and center is Japan. And
Oh,
the Japanese, the Bank of Japan is now stepping in to prop up the yen. And the Fed is playing along with them, like, yep,
We're
we're
helping.
going to help you because the yen has been just a one-way road down to the
and you
point
think
where, when we were starting out our careers, Japan and, Tokyo were talked about as, oh my God, it's the most expensive place in the world. The glass of orange juice at the hotel is $20. Tokyo is now the cheapest big city in the world to go and
yeah,
visit, which is
yep.
just shows how things can flip. But they've stepped in and there's enough is enough. And
And if
obviously,
you,
we've talked about Japan. They're the biggest holder of U.S. Treasury bonds.
I was
And
just gonna say, if
yeah,
you think rates are high now, you
yeah.
wait to see the day those guys say, "Yeah, we're selling," or even we're not buying. We're
Well,
just
Well,
that's why,
just
yeah,
yeah,
kind of
have
that's
some.
that's why we got involved. That's why
Yeah,
Essen came in and he basically sold dollars and bought euro. Like I'm sorry, he bought yen and sold euros, and I
Yeah,
think that was the first time that's ever happened. They said between 5 and 10 billion, because he knows the score. He
yeah.
knows these guys are trying to defend that currency, and one way or the other, they're going to. And they keep trying by intervening and buying, and it hasn't really worked. But he knows, well, all right, if they need to raise dollars to sell, well, guess what? Guess what they're going to sell? They're going to sell treasuries. So we got
yeah,
my buddy Warsh and I are kind of moving the market into this. Hey, let the market be where it's supposed to be on the longer end of the curve. And then he looks at the Japanese, going, "Hey, the yen's at one. It's
He's
a
like, let's not get carried away
yeah.
with
Let's
this
not
whole
get carried.
market
We'll help.
thing.
We'll help you."
You know,
So I think a lot of this was defensive. Why we got involved in their currency intervention. We'll see how that works out.
yeah.
I don't see it. Like, I mean, if they can't get a handle on inflation in Japan, which doesn't sound like it sounds like it's ready to, like, what I heard is like producer prices are way, way up, but they've kind of kept a lid somewhat on consumer, for the consumer, but that can only last so long, right? I mean, and then eventually that's going to pop. And all of a sudden, the 10 years, like I think at 280 right now, the Japanese government bond. And it got as high as I think it got to the 290s. But all of a sudden, like we've talked about this many times, is that yes, those biggest investors in treasuries don't have to stay biggest investors in treasuries. And if the trade isn't working out anymore, and now they can go onshore and just buy their own debt, and not have to do the currency hedging or anything like that. They're going to do that, and guess what? They're not going to buy. They're not going to buy our stuff. Now they may obviously going to continue to buy it, but maybe they're going to buy 75% of what they used to buy. Or that's 15, 20 basis points right there, maybe more.
And I don't know if they have like what they used to call Fed watchers back in the day.
Mm-hmm.
Maybe they'll need to now if he's
Yes,
not
another
coming
job, a
with
job comes
yeah.
back.
Oh yeah. We had I remember a couple guys Fed watchers,
Sure.
and that was in the days when they wouldn't even announce that they've just cut or raised rates. Like your Fed watcher guy had to say, like, I remember the guy going over the hoop, like, ladies and gentlemen, that is a 25 basis point cut. They haven't announced it, but I see the print in the repo market. They've just cut rates, right? So like that happened. So nobody knew, right? And so, but I'm guessing you have like a lot of yen watchers or treasury bond buyer watchers, and the minute, like the Japanese won't say anything, right? They'll just not, like you said, they'll buy 75% of what they used to buy. But I'm guessing like they have guys and gals on these treasury desks all over the street in the US who are watching this number, right? Like they're watching. And the minute that thing looks a little light, guess what? They're all selling. Everybody, right? It's just like, oh, those guys are out, so are we. Boom. And then good luck with that deficit, right? Then we'll really get to see what's up.
All right. Well, good stuff, guys. I hope you all have a great Saturday, and we'll see you next week.
Excellent.
See ya.